Hello and welcome to ACG's Monthly Investor Insights. I'm Bobby Moyer and I am joined with my colleague, Jimmy Pickert. We are excited to put 2021 behind us and welcome in 2022. While 2021 was full of disruptions, inconveniences, and uncertainties, stocks were up and bonds were down. The S&P 500 finished the year with a strong month, returning 4.48% for December and finished the year positive by 28.71%. Small and mid-cap stocks did slightly better during the month, returning 4.53% and 5.03%, but trailed the large cap benchmark for the 2021 calendar year. International developed markets had a good month, returning 5.12%, but only returned 11.26% year to date. Emerging markets were a laggard during the month, returning 1.88% and were the only broad benchmark to have a negative calendar year return, losing 2.54%. While stocks had a great year, rising interest rates put pressure on bond prices. The 10-year Treasury began the year yielding 1.07 and finished the year yielding 1.51%. The Barclays U.S. Aggregate Bond Index lost 26 basis points in December and lost 1.54% for 2021. It was the first negative year for the bond index since 2013 and the third worst calendar year return since 1976.
The year started with optimism around having a vaccine to combat COVID-19, but in November, a new variant, Omicron, caused an uptick in volatility that lasted through December. Health officials initially sounded the alarm that the new variant was far more transmissible compared to the previous strains, which seemed to be confirmed as the new variant was studied. However, the good news was that Omicron seemed to produce milder symptoms, especially in those who have been vaccinated and received the booster. Omicron unquestionably disrupted and continues to disrupt economic activity, fueling additional labor shortages, impacting travel, and in some cases limiting attendance at certain public events. Not to mention that it is already putting a strain on the already exhausted healthcare system. The Federal Reserve held a regularly scheduled meeting in December in which it continued to lay out plans to raise rates in 2022. After insisting that inflation would be transitory for months, the Fed has essentially admitted that higher prices have been persistent and may be around for a while. The Fed was purchasing $120 billion in bonds prior to November, but began tapering its purchases in November and will begin purchasing $60 billion worth of bonds starting in January, with further tapering expected in 2022.
Heading into 2021, the markets were inundated with optimism stemming from the vaccine rollout, massive government stimulus, and an ultra-accommodative Federal Reserve. The sentiment heading into 2022 is much tamer. While many believe the new Omicron variant could be an important step before moving back closer to normalcy, COVID-19 has been anything but predictable. The bulls for 2022 are hoping that the pandemic becomes an endemic, while the bears are fearful that additional variants will emerge. Inflation and the Fed are tied at the hip. If we see inflation subside more quickly than current estimates, the Fed can continue to tighten, but in a much slower and manageable schedule, which would be the preferred path for the markets. There is the risk that supply chains remain tight, inflation remains elevated, and the Fed is forced to tighten faster than the markets are prepared for. In September, the Fed Watch tool was putting a less than 5% probability of 3 rate hikes in 2022, but as of the end of the year, the tool now suggests a 67% probability of 3 rate hikes or more. As we know, as data changes, so does the Fed's narrative and policy.
Through the last 2 years, the consumer, aided by government stimulus, has been resilient. On the surface, the consumer balance sheet continues to look strong, and we see no reason to bet against the U.S. consumer. But with no new expected stimulus on the horizon and workers unwilling to fill the millions of open jobs, we believe that the consumer being weaker than expected is a risk which would have a material impact on economic growth. Thank you for watching. See you next month.